Yeah, so morning. I think it just reinforces the theme, right? We were already at 7%, now we're at 7.5%. We're seeing people sort of scuttle to change or increase the rate hikes through the cycle. But as you say, in reality, we know the first hike's coming, obviously most likely in March, and the Fed will embark on a tightening schedule. And I think we've got that which will cap multiples. And we don't think we're at the stage of the cycle where equity markets can see P multiples expand. We think for now, the debate is all about the earnings. So it's almost a two-way pull and push. And just listening to Steve's comments about how markets so far almost flat on the week, despite some of this macro data, I think on the counterbalance, you have actually some pretty decent corporate profits coming in. And as you're just hearing from that selection of CEOs and CFOs you were highlighting there, companies are actually dealing pretty well with this input price inflation. So yes, higher rates, that will be a problem in terms of multiples not being able to expand. But actually on the counter side, I think corporates are dealing with this better than most people might have expected, actually.
Yeah, no, the earnings story, I think, is very interesting, and we'll get onto that in just a moment. But I just wanted to ask you, if, as now some banks are suggesting, the pace and speed of tightening could be faster than previously anticipated, does that change your expectation in terms of the returns possible in the first half of this year from European markets, given that sentiment is everything at the moment, it seems?
Yeah, so I think in the near term, undoubtedly, it's a road bump, right? And I think, we're seeing that in the volatility, in the moves. We do think you still have an economic growth backdrop that's robust enough to offset the higher rate expectations. We've already derated quite far in Europe, right? So, we had P's over 18, 19 times a year or so ago. We're now back in line with long run averages around 14 or 15 times. So I think the valuations have already compressed to take on the threat of higher rates. So of course, we'll have daily adjustments when we have big CPI numbers or the sort of the non-farm payrolls or whatever people are concerned about. But in reality, I think actually European equities, maybe more so than the US, are actually in a reasonable position to absorb this. And remember, of course, we have much less tech, much less growth stocks in Europe. So we're not as long duration as in the market as the US is. We're not as sensitive to higher rates. And there's indeed some companies, as you were hearing there, some of the banks that benefit from higher rates here in Europe rather than a hurt, such as some of the long duration tech stocks. So I think for Europe, it's maybe less of an issue than for the NASDAQ and the S&P.
Nick, I always enjoy listening to you because I always learn something, but I'm just worried if, I shouldn't say, is the industry too complacent? We have non-financial US corporate debt at record levels, over $11 trillion worth as well. Over $11 trillion, record levels of US corporate debt, which has been raised at the lowest levels in our lifetimes as well. Don't we need to be a little bit worried about this when inflation is surging at 7.5%?
Yeah, debt levels are very, very high. I mean, I think you'd have to look at that relative to corporate profits, which are obviously at record levels, and margins are, astronomical levels. So if you kind of look at gearing and net debt EBITDA, those type of ratios, certainly for the European market, I was just looking at that this week, we're on just over 1 times net debt EBITDA, 1.1. So because the profitability and the balance sheets, the asset side, I guess, is strong, the debt is high in absolute numbers, I agree, but it is bearable. But look, you're right, this has been raised at very low levels. Rates are going up.
Sorry to jump in, Nick. I hear what you're saying about net debt to EBITDA. Is net debt to EBITDA a measure fit for purpose? Because you're talking net debt compared with earnings before interest, tax, depreciation and amortization as well, debt and amortization as well. If you're looking at your earnings before your interest bill and your tax bill, that's a little bit kind of a bit of a spurious measure, isn't it?
Well, it's one measure that people look at. I mean, I think the point to make is the interest costs and the interest payments, even if you look at interest payments to net earnings even, or cash flows, which I think is probably the fairest thing, right? Because you need the actual pure cash flow rather than accounting measures. Those are all very, very subdued in aggregate. And I take your point, there will be parts of the market, there will be people that are more levered, sectors that are more levered, stocks that are more levered, particularly SMEs, maybe mid caps, that have raised capital that is at a very cheap level, that are going to have to pay more for that debt going forward. So we'll definitely have to keep an eye on that. That will be an issue. I just feel for the broader market, particularly given the level, the starting point of rates, for now, it feels to me it's something that can be absorbed in aggregate.